Hey, what's going on, guys? Today I want to talk about an alternative for the covered call trading strategy. If you're not familiar with what that strategy is, definitely go look it up. It is a very interesting strategy that someone can implement whenever they have at least 100 shares of the underlying stock or ETF, or if they have a long call option such as a leap. So, let's go and dive into it here. So this is on the Robinhood platform, but I'm going to hop over to the options screen here and kind of illustrate an example. So selling a covered call normally, like I mentioned, involves having 100 shares or a long call option, and then just selling just takes one leg. So 484 is right here. So you're hoping if you sold a call at 500 that in 17 days, so you're selling time decay and this particular strike. So as a option seller, I am betting that QQQ in this situation will not hit 500 by October 25th. So it's kind of a high level of what a covered call is. But the problem with that is if it blows past it, which if you sell options long enough, you'll quickly realize that you can't always predict the market 100% accurately. So sometimes you'll have options called away, and you'll have these options that are pretty far out of the money, like almost $16 out of the money here. Sometimes go against the direction that you sell it in. So needless to say, with that, when that happens, so I sold it at 500. So anything above 500, I'm capping my gains. In this instance, technically my break even is 501.98. So anything above that 502 level, I'm losing out on because I am obligated to sell my shares of QQQ at $500 a share, regardless if it goes to 600. Selling this contract, you just have to understand your risk, right? Yeah, it's free money, quote unquote, but you are having to, one, hold the underlying asset, and two, give up your upside potential. So sometimes people make the argument that covered calls are, not worth it. And, I can understand in some situations, some stocks, some investments, it may not make sense to be running the wheel or selling premium on it just because, it's a risky investment as is. Why are you trying to, you know, sell your upside? But that's needless to say. So an alternative to that is that you also purchase a call option. So you can see this is a call credit spread. You can see here that we're also buying a long call. So, more than likely, we're hoping this expires worthless, out of the money, but it gives us options, right? So, um, this delta is 19 versus this delta is 12. So really, we're selling like a 7 delta per se. But so what does that mean exactly? So that means we're only capping our upside. So we have 100 delta. Owning a 100 shares of QQQ is 100 delta. If you sell in this instance a net of 7 delta, then really we're still appreciated in 93. So hope that makes sense. Deltas change really quickly, so take these numbers with a grain of salt. Like, you'll have to honestly just keep checking these as things change. So theta changes it, gamma changes it, volatility in the market changes these Greeks. But that's something that I like to look at, just periodically over time. Like, okay, so I'm selling a 19, but I'm also purchasing a 12. So, but needless to say, if QQQ were to break this level and get to like 502, I could let my shares get caught away, selling it there, but then I'm still appreciating a little bit here with this. So obviously this is going to appreciate a lot. So I'll still have some more upside potential there. Or if you want to roll it, you definitely can do that. You can roll the call spread, so it's not going to be as much of a debit lost here. Roll it further out. But needless to say, it gives you more options. So I like having that flexibility. Yeah, I know it's cutting into a big chunk of the premium, but this strategy is flexible because you can, move it around a little bit. If you want a little bit more premium, you just want a little bit on the upside. There's different ways you can do it, and then also, so this normally takes a margin requirement capital of 515 minus 500, so that's $1,500. But you could also turn it into a put spread as well on the bottom, and it doesn't cost any additional margin requirement. So hopefully that makes sense. It's not getting a little too complicated here, but I just kind of wanted to show a possible alternative for someone that wants to sell premium on their underlying asset, but just have some more options, be a little bit more flexible whenever you do sell your upside. Also buying a long call option kind of gives you some of that flexibility. So hope that was valuable. If you got some value from this, please like and subscribe down below. It helps us out a lot, and stay tuned for more content coming your way.